Friends, good morning and welcome to yet another edition of the MultiMillionaire Forum. And we have a very, very interesting topic this time. But unfortunately, the attendance is a little low because we understand this that today is Ganesh Chaturthi, a very auspicious day actually to talk about this very, very interesting subject. It's a subject which has been for centuries the most revered subject, one of the best subjects that people have always spoken on. There has been, legendary work which is done on this subject of blue chip portfolios and what blue chip is all about, etc. So we thought we'll share our little insight into this space. It's a very interesting area, very tricky as well. And we are going to give you a slightly different perspective on this blue chip portfolio and the blue chip investments that we normally do, which is the first thing that we do. So whenever we start our investment journey, whether we are in our 20s or 30s, whenever we start with the blue chip portfolio. So we're going to talk about this area today. So as we always do this, this is purely educational for the information of all the people who are watching this forum for the very first time. And this is a standard disclaimer that we have to put in, which we say that there's no product, there is no service, there is no marketing of any sort which is done here. It's just pure education. So feel free to spread the word around. And we have certain requisite registrations, as you can see on your screen. And as a result of which we're brokers and distributors largely. But this particular activity that we do is just an educational initiative and completely free of cost for everyone. All right. So, getting into the subject of blue chips, and the title itself is quite interesting. I mean, why have we actually said that? Is this the end of blue chips? That's because a lot of times we believe that this is an area which is going to create the maximum amount of wealth. This is the area which we should be invested in permanently. This is an area which our elders and the wise people of the world and the investment gurus, everybody talks about this area, and this is the area that you cannot not have in your portfolio, because no matter what will happen to the stock market, to the bond market, to the economy, these companies which are known as blue chips, they are known as blue chips because they have been around for centuries, if not decades. Some companies are really, really old. They have a huge legacy, and they have been nation builders, not only for our country, but blue chips anywhere and everywhere across the world. And that's the kind of role they play. So let's look at the formal definition of blue chip. Exactly what does this mean? So these are companies which have a solid balance sheet. I mean, I just picked up from Google, and you can pick up the same. They have steady cash flows. They have business models that have been proven, not only proven, but their business models have also got upgraded over a period of time. So if they were into manufacturing items A and B, they felt that they needed raw materials A1, A2 to manufacture A and B. So they went into that. And then the companies would have also felt that A and B can be transformed into another product C, and there is a huge market for that. So there's been a sequence of constant evolution of business for these kind of companies, and which is why they've been around, and which is why they've always been the shining star in all our portfolios. So blue chip stocks is one part, and the mutual funds which actually invest in these blue chip companies. A lot of mutual funds themselves have the name which go by XYZ blue chip fund, XYZ emerging blue chip fund, etc., so on and so forth. So there are various variations of names, but they like to include this blue chip name. It's almost like a household name. It's become a brand name in itself, that I would like to invest in blue chips. If somebody would have asked me for the first time in their life, I want to make an investment, I would say, first thing to do is buy blue chips. Grandfather would say, buy blue chips, buy these companies, keep them in your portfolio and fill it, forget it, and shut it forever. You need to do nothing with these blue chips. They are like the best things that money can buy, and there is nothing in comparison to what blue chips can do. What other things can do which blue chips can't do for you. Having said that, again, for the benefit of people who are watching this thing for the first time, we have this session and we speak for about 30, 35 odd minutes. And then we have a Q&A session. The Q&A session is not recorded, but in that Q&A session, it's a very free-flowing session. So there's lots of learning that happens in the Q&A session. So which is why I urge you to stay back and join the live session, because the Q&A is not a part of the recording, right? So just a matter of information. So let's move on. Let's look at this data. Very interesting data. Okay. See, today is a day, the perspective that we wanted to bring to you for Bluechip was slightly different. It's not education about why Bluechip, because we don't need to prove to you that why company A or B or C is absolutely brilliant. I mean, we all know that. If we talk about the best technology company, or if we talk about the best pharmaceutical company, or if we talk about the best consumer company, we all know these respective companies in our respective countries. And pretty much we can even identify such companies in other countries, where we are not even investing. It's very, very obvious. But here is, it's going to be a little bit of data. If you sort of get lost in the data a little bit, just make a note of it, and I will come back to it in Q&A, and we'll talk about it. But try and grasp the essence of it more than the numbers, okay? And I'm going to try and make it as simple as we possibly can. So there's something very interesting here. We have shown you the data of 2019 and 2024, all right? And what I'm going to try and do is I'm going to try and annotate a little bit, okay? Just give me a minute. Yes, so as you can see, we have data of 2019 and 2024 right in front of you. So we've tried to make a comparison of the last 5 years. Now, just for the sake of understanding, what is a market capitalization? Okay, I'm just deviating a little bit. So you have 100 shares of a particular company, say company A. The value of that company, the share price value of that company is 1,000 rupees. All right. So what that means is 100 rupees into 1,000, 1 lakh rupees is your investment, and that's the value today of the company. So we would say that the market cap is 1 lakh. I mean, if there were only these 100 shares in the whole market, then we would say that the market capitalization of the market is 1 lakh rupees. Because what we are trying to do is all the quantity that all of us hold for one company A, and then we add to that company B, C, D, E, F, G, I mean, to all the 2,000, 3,000 odd companies that are listed on our markets. When we add them all up, what we get is the market capitalization of the entire market, okay? So it's an extremely large number. As you can see on your screen, this number is $5.47 trillion, or in rupee terms, it's 458.9, say almost 460 lakh crores. So humongously large number beyond our imagination. But anyway, the focus is not that real number. The focus really is this number here, 122. And if you can just see this, 122 and 284. So what we are trying to show you here is that the total market in 2019 was here. I'm just going to make a square around it, was 158. Okay. 158 was the value of the total market in 2019. And today the value of this market of ours is 459. So this is almost, as you can imagine, 3x, right? It is 3 times 3x. So in the last 5 years, in other simple English words, the market capitalization has tripled. Okay. What you can see on your screen here is Nifty 50. Can you just take your cursor there and point there? Nifty 50, and the index value being 11,200 approximately. So I hope you're all able to follow that number. So that was the number of the index in 2019. Today, that number is more than double, standing at 25,268. I am just setting the context. I have not even started explaining what we are trying to show you as stuff. Okay. I'm just summarizing a comparison between 2019 and 2024. the Nifty, or the market as we call it, was at 11,000. We talk about Nifty more than the Sensex, but proportionately the numbers mean the same. In 2019, we were at 11,000. Right now, we are at 25,000, which means we are more than double, right? That is what has happened in 5 years. Okay. So how do we say that we are double? We all know the index number, but the more interesting number to look at is the market capitalization. So if I look at the top 100 companies, can you put your cursor? Yeah, which are typically the large caps or the blue chips. Okay, this large cap is nothing but BC. This is the blue chips. So this large cap moved from 122 in value to 284. So basically, sum total of all the blue chips together, all the companies, moved from 122 to 284. Again, that's more than two and a quarter times, 2.3 times to be precise, okay, which is explained by this last number here, which you see here in front of you, 2.32. Okay. So I'm going to go very slow, okay, because this is very important that you understand the essence of this. 122 was the value of all the blue chips put together. Today, it is almost 284, okay, almost 2.5 times. Likewise, if you look at the mid cap now, which is 150, the value of those mid caps was 22 5 years ago, and today it is 85, almost 4 times. Okay, then the small cap correspondingly, the 250 stocks of the small cap was 11, and which is standing at 45 right now. And the micro cap, which was at 3, is standing at 18, which is 6 times. So these are the different sections of the different buckets of the market. Blue chip has gone up about 2.5 times. Mid caps about 4 times, small cap about 4 times again, and micro caps about 6.5 times. Now, what is most interesting here? Oh, just by the way, for your reference, the figures in yellow color are the index values. The figures in the orange value is the market cap, or the total growth of all the companies put together. Now, what is very interesting is market share. Now, what I mean by this market share is, in 2019, see, the total market size was 158, right? As you can see. Can you just point 158, please? Yes. So the total market size was 150. So if I were to take 122, the number which is the value of the large cap, and divide it by 158, I get the answer as 77. So which means in 2019, out of the 150 rupees the market, 77% of the market was nothing but blue chips and large caps. Fast forward to 2024, at the present time, and this data is, as you can see, up to 1st of September, which is basically 31st August. Okay. Come to 2024, the total market is 450, and large caps as a percentage out of that, 284. So 284 divided by 459, the value is 62%. Now, look at this drop. Now, this is where the shock is. From 77, it has dropped to 62. Okay. Now, what I mean by this entire activity, what have we just done here? We're trying to say that, see, markets have moved up. They've more than doubled, right? Everything that was there pretty much in the market from 2019 to now has more than doubled, including our blue chips. But there are other pockets which have gone way ahead of the blue chips, right? But the point of concern is that the total amount or the total wealth that you and me and everybody else has in these blue chips reduced. So out of the total market size of that 450 that we showed, currently, if we were holding blue chips, we obviously have not made enough money. That is pretty obvious. But what is not so obvious is that are these blue chips losing their power? Are these, because see, proportionately, if the market share is maintained, if the percentage of blue chips in the total market remain the same, then it's fine. We don't have a problem with that. So if they were 70% of the total market 5 years ago, and if they are same today, then we don't have a problem. But if they have dropped and dropped by 15%, it's almost a 20% drop, that is concerning. Okay. See, you might even know, and some of you who are observing the market more closely might realize that the Nifty 50 stocks that we have, or the 30 stocks that comprise the Sensex today, are very different from what they were 20 years ago. See, index and the stock exchanges also keep modifying the index to reflect the economy properly. But despite their efforts, if the share of market caps has gone down, then this blue chip becomes a little bit of a question. And which is why we made this title what we did, the end of blue chips. Okay. But is it really the end? Of course not. Okay. So everybody can just breathe easy. Okay. This is definitely not the end of blue chips. Blue chips have been around forever. There's never going to be an end to that. So please be rest assured on that. Okay. I want to clarify that. Now, after all this drama and suspense, just to tell you that blue chips are fine. Okay. Don't worry. Okay. But let's move further. Let's now open the hood and get into exactly a little more of the data. Okay. You are going to be blasted with data, but don't get worried. There is only one little number that I want you to focus on, just one piece of data. In the Q&A, we can talk in detail about it. Okay. So let's sort of look at this data. Okay. Like I said, there's too much of data on your screen. Forget everything. Just only focus on price growth 5 years, as you can see right on top. So this particular private bank, I mean, this is the balance sheet of a private bank. We will talk about the details if somebody is interested in the Q&A. But right now, for your reference, this is a leading private bank. Now, these companies we have picked up from Nifty 100, which is the top 100 companies of India. And obviously, these companies are all blue chips, right? And, you know, some of us can even guess that we might even be holding most of these companies that I'm going to show you. And I'm going to run through quite a list. Okay. They are all there in your portfolio, or a lot of them will be there in your portfolio, directly or via a mutual fund indirectly. Okay. But the point I want you to focus on is, look at that number. Can you just please identify that number of 5 years, 29.80? Can you please bring your cursor there? Price growth. That's all I want you to look at, right? Nothing else. I just request you to focus, and just a second. Okay. Let me also. Can you just can you identify? Can you click on that? Or yeah, 29.80. That's what. No, don't go anywhere else. Just 29 price growth for 5 years, 29.80. If you can bring your cursor there, please. It's there. Okay, I just got my annotation back. Friends, this is all I want you to focus on. Okay. 5-year number and 3-year number. What this number simply means is that this company in the last 3 years has given a return of 19%. Last 5 years, compounded growth rate of this company, our wealth, basically the price of this company, has gone up by 29.8, say 30% and 20%. Okay, got it? Everybody okay? So that's what I want you to focus on. Nothing else in the screen, just this number, 5 years and 3 years. Okay. So this is a good private bank, right? Okay, now we are going to go faster, assuming that everyone's understood what we are talking about. Okay. If there's any doubt that any one of you has, want me to clarify this, because we're going to go through quite a few of them, then you can just raise your hand or, unmute yourself, and we'll just address this thing right now, because it's important that you're able to appreciate what we are going to now speak of. Okay. Any questions, Ari? Can you see anything on the chat or any? Nobody. Okay, good. Fine. So what we are going to do now is, let's move forward. So this particular private bank, 5 years has done 30% growth, and last 3 years has been 19.2, or say 20% growth, simply. Okay. Fantastic. No problem. Let's go next. Next slide, please. Yeah. This is another private bank, friends. Here, the growth of the last 5 years has been 9% only. And last 3 years, it's almost zero. In fact, it has gone down by almost 1%. If the price was 100 rupees 3 years ago, today also it is 100. In fact, it's not 100, it is 99 rupees. 3 years, this is what's happening to this private bank. So we showed you one good private bank, part of the Bluechip, and this is, of course, this is a great private bank, but the performance of this company has been not so great. Okay, I can't dare to say that this is a bad company. They are fabulous companies, each one of them, and guaranteed more than half of them are in your portfolio. Okay, directly or indirectly. Move. Now, this is a consumer company. Look at the 3-year growth, 16%. Great news. Let's look at the next one. This is yet another consumer company, 88%, mind-blowing performance. Can you imagine? Last 3 years, 88% growth means, it's insane. The company has probably gone 5x in terms of the share price in the last 5 years or more, right? So fabulous result. But here is another consumer company, which is at zero. Are you getting the sense of what I'm trying to say? In this bucket of the 100 companies, the best 100 companies of our country, there are some consumer companies, some banks which have done fabulous. There are some consumer companies, some banks, we've just shown you 2 examples, which have had pathetic share price performance. Okay, which, see, this translates into your mutual fund. Doesn't mean that it doesn't come to your mutual fund. Mutual fund also naturally will get impacted by this, right? Let's move on. Let's see a lot of examples. Okay, metals. This company 24% for the last 3 years. Are you with me? Can you always just point at the number that I speak of? So if somebody's just joined in, they don't feel lost out. So price 3-year growth 24%. Next. This is yet another metal company, 30%. Go on. Slow. Okay. So incidentally, metals, we couldn't find anything which was a bad performer. So that was a good performer. Both those companies were great. Okay. Now this is a chemical company. Again, stupendous, mind-blowing growth. Now 50%. And what a consistent performer. Last 5 years also almost 50%. 3 years also almost 50%. So if we have this company, we are like smiling, all years. But if you see the next company, the next chemical company, now look at this company. Last 3 years, only 5%. A fixed deposit has done better than this. And this is one of the best companies in the country. Okay. You all have it, directly or indirectly. Okay. Let's move on. This is an insurance company. Last 3 years, price growth, not impressive at all. 10%, 13%. Why do we even invest in 10 and 13? Pointless, right? Let's move on. Look at this insurance company. 5 years has the same 14%. So, okay, we can pass it on a 5-year basis. But last 3 years, minus 1%, zero. 0 or minus 1. It's like really sad. But, and by the way, okay, let me also make one more remark. Not for this insurance company, but generally speaking, I'm making a remark. You know what we've shown in this yellow patch here is the sales data. So this is the sales, as you can see, okay? So sales have been, for this particular company, from 38,800, 39,000 to 1 lakh, almost tripled in 5 years. Huh? So sales has gone up, okay? Profit, which was at around 1,200, profit is marked in green below, okay? Profit, which was at 1,300, has been 1,600. It has profit making every year. Profit is also growing. The sales of this company are really shooting up, but there is some problem. Now, I'm just showing it for this company as an example, but the same is applicable for every single example that we've shown. Because like I said, these are the 100 best of the country. This is a sample out of the 100 best. We're not showing you 100 here. But in every industry, we are seeing couple good, couple of them really bad. Okay, let's move on. Some more examples. There are lots of examples. Literally every sector. Technology, 8% in the last 3 years. See, the amount of wealth destruction that happens and the opportunity loss that comes in. By sticking into these places, the money is not really growing. Right? And these days now, even the tax has gone up. Long term has become 12.5% from 10%, and short term capital gain has become 20% from the earlier 15%. So The tax is rising, but the company is not growing. Sorry, correction, my bad. Company is growing, as you can see. From 1,50,000 of sales turnover, it has become almost double, 2.5 lakhs in 5 years' time. So they're doing superb. 50% growth in sales and profits, but the share price is not growing. Okay, next. This is technology again, about 12%. Again, why should we invest? Next. Financial services. Okay, by all standards, a brilliant company and brilliant performance already on your screen. Last 3 years, 27% return. Okay, last 5 years, 31% return. Move on. Look at this financial company, which is going to come up next. Look at this. Price growth in the last 5 years of 5%. Price growth in the last 3 years of just minus 10%. I mean, degrowth. Okay, mind you, look at these numbers. Look at the sales of this company. From 7,000, it has gone to 17,000 in 5 years. 2.5 times the sales has gone up. The profit from 865 in the green box has gone 3 times to 2,400. And every single year, good profit and growing profit, okay? Despite that, the share price has been down. Now, this is the reality of blue chips. Okay, so do you now see why also there was a reason to title it what we titled this program today? Move. Healthcare. Look at this one. Last 3 years, 2.5%. Let's move on. And this particular healthcare company, again, brilliant, 41% in the last 3 years. So you see the disparity. In the same section, same sector, in the same country, of course, which is our country, 2 companies, both growing, but share price performance is so divergent. Let's go on. This is construction. -3. And next. 18%. Again, look at the diversity. Go on. All right, okay. So what's happening here? What we just saw, the journey that we just had, okay? My team, has compiled it, and great job that they did of compiling this data. Now, the thing is, in the same sector, what if we were invested in these companies which were not the growing ones? Of course, if we were invested in a company that grew really well, we'd be very happy. But what if we were in the other one? You see, and we are so emotionally, so tightly held about this company. Oh, this company gives me the best dividend. Do you know how many thousands of rupees or lakhs I get in dividend out of this company? But so what? You're getting 1% value or 2% at the most. Whatever you're holding, you don't get more than 1 or 2% of that as dividend. Okay, so that means your holding is really large for you to get a very impressive number that comes into your bank account as a dividend. But now on that also, you have to pay 20 or 30 or whatever is your tax rate. You have to pay that much tax on it. So post-tax, again, not very impressive. But see, the point is, penny wise, pound foolish. The original capital itself is not growing. Because if you're growing at a 4%, 5%, 10%, such an ordinary growth rate, and you are holding one of the best companies of the country, it's a question to ponder on, right? Okay, let's come back to our presentation. So why does this happen? Because we live in the past. And we know history repeats itself. This is, God's wisdom in one sense. Because what happens is, I told you that this company is good and it will always do good. So maybe it does bad for 3-4 years, 5 years, and then suddenly becomes good for another 3-4 years. And then it goes back into a slumber for another 3-4 years, and again comes back alive again. But now, is that how we want our wealth to also, sort of move? That our net worth is 100 rupees today, 100, and then suddenly from 100 it goes to 140, 150. We feel very good. See, I told you it went up. But hey, after 3 years, it went up 50%. So if you divide it by 3, the average rate is just 15% per year, right? Not so impressive. Okay, so this is what is the problem, okay? A lot of times we live in the past, and we all do that, right? I mean, it's extremely, extremely difficult. I've been doing this for 21 years, and why talk about anybody else? My own holdings, it's been extremely hard sometimes to sell and let go of the past. But if I invested in some company, like 20 years ago, if I'm still holding it, and it has become 10 times and so on and so forth, 8 times, I still feel, maybe it'll do better. Maybe I should just hold on to it. Maybe I'll just come back to it. Because, there's lethargy in taking that decision. I don't want to take that decision. It served me well. So what if it doesn't earn? And sometimes people have gone to the extent of saying, oh, this is that one child which is not so good. It is like a weak child. So we have to support the weak child, right? I mean, typically this happens in our households, right? I mean, if we have two children or three children, sometimes we feel, oh, this is the weaker one. This guy, this boy or this girl is like really smart, but this one is not so. So I need to support a little more. We start treating our stocks like that, which is quite horrifying, but that's the reality. So let's sort of, let's sort of understand. It's very easy to say, don't get emotional about it, but the fact is we are emotional beings, so we are going to be emotional about it. But let's also sort of give cognizance to the fact that, you see, new blue chips keep coming on the surface all the time. So history doesn't necessarily repeat its rhymes, right? We've heard that one. So the point I'm trying to make here is that blue chips are always going to be around. They are one of the best places to be, but we can't have too much of our money in there. We can't have like 60, 70%, 80% in that and hold on to it on our hearts and on our chest saying that we are never ever going to let go of this. Hey, but you might be in the bad one. Okay, it's very easy to find out. It's like literally a 2-minute job. There's nothing which is hidden. All you have to go into a public site like like a Money Control or I mean, today there are like 24 sites. Trendline is one and Mojo is another one. There's so many sites that give you live quotations and history as to what was the price 5 years ago. I mean, you can even go to the exchange. Well, exchange NSC, BSC websites are huge. They're mammoth. To even navigate your way and find out is a little difficult. But if you've seen it, you will know. And the point is, there are new blue chips that are emerging all the time. There are thousands of companies that are coming to the IPO market. They are, of course, small micro caps and small caps today, but a lot of these will become blue chips of tomorrow. So the company's journey is from a micro cap to a small cap, and micro doesn't mean like 5 crore company. Huh? Micro also means it is like 2,000 crore company. Then it will become small cap, which will say range between, I don't know the exact ranges right now, but say between 5,000 to 20,000 crore. 20,000 crores is not small. Then maybe mid cap is from 20,000 to say 40,000. I'm just giving arbitrary numbers, not the exact numbers, but just to give you a sense. They broadly will be in that range. It changes literally every day because the market works every day, right? And then the mid caps are between 40 to say 80, 100,000. And then you have the large caps, which are say from 80,000, 1 lakh crores and upwards. And then you have the giants, which are 5 lakh and 10 lakh crores and plus that kind of a number. These blue chips go and undergo transition. Sometimes we've also, by the way, I'm sure a lot of you also know business families, right? Which were the best, which were at the pinnacle, which were the best of their times, say 20 years ago, but today they are not. Today, they are literally gone, disappeared. And if you are living in Mumbai, then a lot of you will identify with the fact that, literally in your neighborhood, not even 200 meters, you had these, huge industrialists, and today they're not even talked of. I mean, there's no company that they have which is forget creating wealth for others, it's destroying their own wealth as well. So, that's there in front of us, right? So basically, how does one identify where are these new blue chips? So one great way, or one great trigger that happens is, the economics and what the government does. So government policy, we spoke about this in detail, in a couple of sessions earlier, so I'm not going to dwell too much into it, but this is just to give you an idea. The government wants to focus on something. Not very often we see a scenario where on its own there is enormous demand. Like, for example, say artificial intelligence. We know it's a great tool. So there is an automatic demand. So now if a company was manufacturing artificial intelligence related service, then automatically there is an inherent demand that is created. But I mean, even if we want to have a road to drive on, till the time the government decides to have infrastructure, we can't do anything about it, right? Because you and I are not going to go and build a road. So therefore, government policies and government measures, announcements, once they start doing some things, then the elephant starts to dance. It's basically that. So one is like a huge trigger, demand coming in from a government point of view. So that is already happening. It's already happening here. We're seeing a lot of that, whether it's infrastructure or defense or a lot of the other undertakings that we're doing, right from semiconductors to power to renewable. so on and so forth. We've spoken a lot about that in our previous sessions, so you can have a look at those videos. So that's the how of the things, right? Now, where will you find these? Like I explained a while ago, a company's journey starts from a micro to small to a mid to a blue chip. So here's the crux of the whole thing. Okay, one of the things that we really want to do is take a very, very hard look at the blue chip portfolio. And don't listen to me, don't listen to anybody, don't listen to any market guru who's coming up. Open one of these free websites, see it for yourself. Look, and I'm sure you also know, has your money really grown in this company for a long time? And is it holding a disproportionate percentage in your portfolio? I have seen portfolios sometimes which hold 8 figures, 9 figures in just one company or two companies. And the portfolio is large, but those one or two companies comprise almost 70, 80% of that portfolio. Everything else is like, small change. So one needs to have a very hard look at that. And once you have a hard look at that, pay attention to where the demand is, where the focus is of the government of economics, and very simply put, which company is smaller right now and which has the potential to become large. Now that's a little difficult, and therefore there are some roads and some ideas which we are going to present you, and they're coming up on our screen in just a bit. Okay, so what are some of these ideas that you could possibly look at? Okay, one, of course, you're going to laugh at this. One is, of course, our good old mutual fund. Okay, it's almost ironical that we're talking about mutual funds, and because one expects to see some very, very fancy ideas. But look at the most beautiful thing that you already have. It's already in your backyard. Just look at it now. Now, I want you to focus on some of these numbers. So all the green columns numbers in front of you are the 3-year returns. The blue is the 5-year return, and the orange one are the 10-year returns. And what we have done is we have taken the best funds or the best performing funds in the country and given you a summary or a synopsis of that. Okay. So in the large cap category, which is the blue chip, which is the area that we are talking about, that's the subject of discussion today. What has been the 3-year growth rate? Can you please point out? Can you go there? Let me see if I can also sort of circle it. So for everyone's benefit, this is the one that we are talking about. 17% compounded growth rate. Okay. Now, there's a lot of things I want to talk about. Just remember the 17% number. These are mutual funds. These mutual fund managers have given you a last 3 years compounded growth rate of 17% on your large cap fund. Okay. How much was the 5-year data? How much was it? Okay. So it was 16.89. So that's also say 17%. So last 3 years you've made 17%. Last 5 years also you made 17%. Which means your money is almost sort of doubling in about 4.25 years, maybe 5 years, 4 years actually at 17%. Question to ask yourselves: is your equity portfolio growing at that speed? You are holding shares indirectly. This mutual fund manager has bought shares for you indirectly. I mean, so you are holding them indirectly, right? You can see what the portfolio is, and they are doing what they are doing with that portfolio. They are buying and selling continuously through the whole year. Okay, they are not traders. Okay, they are also investment experts. So they are, changing your stocks. They are not married to any stock in their portfolio. So they may hold it for many years because it's obviously doing good, but they're not going to hold it forever the way you and I do, right? Question to ask is, if you had like those barrage of reports that we just showed you, where one chemical company was, doing 20%, 40% returns for you, the other one was at -5. So if you have one company which is doing, say, 40% in your portfolio and the other one which is doing -5, you take an average of that, you drop down to 20%. And your average keeps coming down. What I have observed in 21 years of doing this, average equity portfolio returns for most investors, now listen to this very carefully, okay? Average equity portfolios, DIY portfolios, do it yourself, the portfolios that I and you, the ones that we manage ourselves, okay? And even I'm no exception, okay, until many years. All of us are somewhere in the range of 12% to 15 or 16%. That's it. You may think that this stock has multiplied so many times. You may think that I've made so much of money here, but there are others on which you've lost money. or not made enough money. So the point I'm trying to make is, why is that mutual fund guy itself a very good idea? Because he's made more than you and me. He has that fund has delivered 17%, right? Can you show the screen up again, please? So the fund has delivered 17%, or this category average has given 17, which means there will be some which are above 17, some which are below 17, right? But the average is 17 here. So in the same fashion, now I just want to repeat this thing, okay? So you really get what I'm trying to say. In a different way, we think that we are very clever. We think that we're doing a fabulous job managing the portfolio ourselves. But the truth is, and what I've observed and what the data shows is, that's not really true. Because this is not our professional activity 24/7. The mutual fund manager's job 24/7 is to manage our money. And therefore, he does this kind of a return. We have not generated 17 and 18% compounded return over a 3-year and 5 years. Okay, but these guys have on a 3-5 years. On a 10-year, it's not looking good. It's 14%. See, this is actually the problem also. Look at the last 1-year data. Can you please point the last 1-year data? And we have a problem of short-term memory. We only remember what has happened in the short term. We don't remember the long term. So last year, average blue chip portfolios have done about 30-33%, because it was 23. It was a fabulous year. Starting from April 2023, we had a fabulous rally in the stock market. So everybody's portfolios have gone up 30% on an average. So we are feeling fantastic about it. But we forget to do a calculation of 5 years and 10 years to really see how we are performing. And that's the revelation that we're trying to do here. So last 1 year, let's not even talk about it. Everybody did fantastic. But last 3 years, 5 years, look at the 10-year return also for this category. It's 13.9, 14%. This is also in the median of where we are doing. So now, if the fund manager has done a 14% average for 10 years, and if our average is also 14, which is between 12 and 16, then one may want to think that why are we spending so much of time doing it? May as well, and this is, by the way, the return that they have generated after fees, okay? After the mutual fund charges have been applied. So may as well let somebody, handle the portfolio versus trying to do it myself. Okay. Now, this is not the holy grail of the one. This is not the only place. What I said a while ago is that one must take a very hard look and look at the fact that there are other things other than these blue chips and diversify your money across everything else. So we are only focusing on the 3-year returns. Look at the category called large and mid cap. They've done 22%. Mid cap has done 25%. Small cap 27%. Okay, at 27% means your money is doubling in 3 years. Mind you, every 3 years it is doubling. Has your money doubled every 3 or 4 years for the last 20 years? See how many doublings have you got, and see how many doublings these small cap funds have done. Okay, and I'm personally holding some small cap funds where I've even seen a return of 9x and 10x in the last 10 to 12 years, my own holdings. So have we been able to do that in the DIY equity share portfolio of blue chips? Big question mark. Okay, let's go on to idea number 2. Okay, now the thing is, if you want to make it a very, very low cost kind of a thing, I don't want to go to a mutual fund. Why should I pay somebody? Let me just manage it myself. Then from that point of view, this is not something that we recommend. Okay, I'm not recommending this. I'm just giving, on one side, I showed you a mutual fund which typically charges you in the range of 1.75 to 2.5% as fund management fee. And here is one particular product where the fee would be, I don't know the fee, but it's really very, very low because it's an index fund. Okay, but this index fund is a very interesting fund. You are buying the whole 500 S&P 500 or Nifty 500. Basically, you're buying all the 500 stocks of the top 500 of the country. So the red bars that you see here are the return. And by the way, this is a fund. I mean, again, sorry, there is a Nippon. We don't like to promote anybody here, but this is something that Nippon has just created a fund like this. By the way, I want to clarify that. So we're not promoting them, but Nippon. This is a presentation which I sort of borrowed this from the Nippon presentation. Okay, that's why you see Nippon's name written here. But if Nippon has made a fund on Nifty 500, and if anybody A, B, C, D, E, F, G, or if you yourself buy the Nifty 500, the returns are identical because you're buying the same index. It's just that the vehicle is different. This is Nippon vehicle. You could be in some A, B, C, D other vehicle. Okay, because you're buying the index. Remember, index is the same no matter who buys it. Okay, so just to sort of clarify. maybe we should have just given the credits here and removed the word Nippon. Okay, anyway, so the point is, as you can see, that out of the 19 calendar years, last 19 calendar years, 14 times it's been positive. And the only times it has been really negative has been 2018 and 2019, which is 2018 was minus 20%, 2019 was very tiny negative. And the other two big negatives were in 2011 and 2008. 2008, of course, we all know the US housing crash, and as a result of which we all got punished for that. 2011 was a normal fall of the market. 2018 was also a fall in the small caps, but not in the large caps, and that's why it sort of balanced itself. COVID, hardly there is a difference because it's talking of a calendar year, so you don't even see a negative year. Even in 2020, we have a 27% return, and 2021 also it's a 50% return. So that's another idea to think about. Absolutely low cost idea. This is really a DIY idea if you want. That sort of thing. So, and of course, 3, 4, and 5, we can keep talking about endlessly. So there are lots of other ideas that one can use. But the objective of today's session was just to sensitize you and everybody else who's managing their portfolios in their own, in blue chip stocks especially. Please take a very hard look at your portfolio. You may want to really think about doing something else about it. So with that, what I want to do is I want to close my conversation.